Sitting on a ton of home equity, but don't want to give up your low rate first mortgage loan? You're not alone. And the good news is you don't have to refinance to access that cash. Wait, tried to qualify for traditional HELOC? Maybe your debt to income ratio is too high or your income doesn't fit into traditional box? No problem. There's a solution called a non-QM standalone second mortgage, also known as a closed-end second lien. And in this video, I'm going to break down exactly how it works, who it's for, and how it might help you tap into your home equity without touching your first mortgage. Hi, I'm John Thomas, loan officer with Primary Residential Mortgage. And if you're a Delaware homeowner looking for a smart, flexible way to use your home equity without refinancing, you're in the right place. For more resources, you can check out the full article on my website at delawaremortgageloans.net. A standalone second mortgage is exactly what it sounds like, a second loan secured by your home, but completely separate from your existing low-rate first mortgage. That means you can keep your low 2, 3, 4% first rate mortgage and still access the equity you've built up in your home. Rather than refinancing everything into a higher rate loan, you can take out a second lien for a lump sum, usually up to 90% combined loan to value, depending on your credit, your income, and the property type. It's ideal for homeowners who've built up equity or investors, but don't want to start their mortgage over or lose their low interest rate first mortgage. So what can you do with it? A non-QM standalone second mortgage can be used for debt consolidation to pay off high interest credit cards or personal loans. You can use it for home improvements to remodel kitchen, build an addition, or even use it for energy efficient upgrades. Major expenses cover tuition, medical bills, or investment opportunities. You can even draw out to buy investment property. Now here's where the non-QM part comes in. These loans are designed for borrowers who may not fit the standard guidelines. For example, self-employed borrowers, real estate investors, or those with unique income situations. So you can qualify with flexible documentation such as bank statements, 1099 income, profit and loss statements, or even a DSCR program for investment property that doesn't require any income documentation at all. Now let's talk about why this option has become so popular. With rates much higher than they were a few years ago, most homeowners don't want to refinance their entire mortgage. So if your current rate is in the 3s or even the 2s, you're better off keeping it and borrowing only what you need on the second mortgage loan. That's exactly why a standalone second lets you do. Tap your equity while keeping your low rate first mortgage. Now, compare a HELOC to a closed-end second, you get a fixed rate, fixed payment, and a specific term on the home equity loan of 10, 20, or even 30 years. There's no draw period, there's no variable rate surprise, and no fluctuations in the monthly payment that you get with a HELOC. It's predictable, stable, and ideal for long-term financial planning. Here's an example. Let's say your home is currently worth $500,000. Your first mortgage is $300,000. With a standalone second mortgage, you could potentially borrow up to 90% combined loan to value, which means you secure a loan for about $150,000. That's a lump sum of cash you can use immediately, and your existing mortgage stays untouched. It's a clean, simple way to leverage equity without starting over. Here are the basics. You need a minimum 660 credit score to qualify. Loan amounts start at $75,000 and up. The maximum combined loan to value first and second is up to 90% depending on your credit and your documentation type. And you can get flexible terms between 10, 20, and 30-year amortizations. We can do primary residence, second homes, even investment properties. Income options include full doc, 12-month bank statements, 1099, profit and loss with bank statements, written VOEs, even DSCR for investor income. The loan is perfect if you've got a low interest rate first mortgage you don't want to refinance. You have equity, but your debt to income documentation doesn't fit conventional rules for a HELOC. You're self-employed or your own income outside of your W-2. You want fixed payments instead of variable rates like a HELOC, or if you had a credit event in the past, but have reestablished strong credit but doesn't qualify for traditional income like a HELOC. If you're ready to see how much equity you can tap without refinancing your first mortgage, reach out to me today. John Thomas, loan officer with Primary Residential Mortgage, your local expert in non-QM second mortgages and home equity solutions. You can call me directly at 302-703-0727. Reply online anytime at PRMIloanapplication.com. And don't forget to check out the full article. The link is below in the description for all the details and current program guidelines. If you found this video helpful, hit the like, subscribe, and turn on notifications for more mortgage tips and equity strategies to help you make the most of your homeownership journey.